After reading hundreds of books about money, investing, business, and wealth, you eventually discover that successful financial principles repeat across generations and markets again. The details change, but the foundation remains simple. Spend less than you earn, invest the difference, avoid costly mistakes, and let compounding work patiently. Understanding these principles is easy, but consistently applying them for decades requires systems, discipline, patience, and the willingness to ignore short-term financial decisions. If you enjoy practical wealth-building ideas, please like this video and subscribe to our channel for more useful financial education and investing content today. First, automate saving and investing immediately after receiving your paycheck, because relying on leftover money at month end often means nothing remains available for wealth building. Automatic contributions turn paying yourself first into a system, allowing your lifestyle to adjust naturally while your investment accounts steadily accumulate productive assets regularly. Second, avoid spending every raise you receive, because higher income creates wealth only when your expenses grow more slowly than your earnings over time. Use promotions, bonuses, and business growth as opportunities to increase your investment rate, while still allowing yourself reasonable improvements in lifestyle, comfort, and security. The goal is to create a widening gap between income and spending, because that financial surplus becomes the capital available for future investments regularly. Third, turn earned income into ownership by regularly purchasing productive assets that can potentially generate income, profits, appreciation, or other long-term financial returns consistently. Stocks represent ownership in businesses. Real estate can potentially produce rental income, and businesses themselves can generate profits while increasing in value over time. The exact assets you choose should reflect your goals, risk tolerance, time horizon, diversification needs, and personal circumstances rather than following someone else's strategy. Fourth, eliminate high-interest debt, because compounding becomes dangerous when expensive interest charges continuously consume money that could otherwise become investment capital every month, quietly. Paying down costly consumer debt can improve cash flow by eliminating future interest expenses, after which those former payments can be redirected toward investing. Fifth, maintain enough emergencies without being forced to sell long-term investments during unfavorable market conditions, during serious household emergencies. An adequate cash reserve provides flexibility when income disappears or markets fall, helping protect your investment plan from short-term financial emergencies and forced decisions. Sixth, keep investing simple and inexpensive, because complexity, excessive trading, high fees, and unnecessary decisions can reduce returns. For many investors, diversified low-cost index funds provide broad market exposure while reducing the damage that any single company's failure can cause over time. Low expenses matter because every unnecessary dollar paid in fees is money permanently removed from your portfolio and therefore unavailable for future compounding growth. Seventh, pay attention to taxes, because your true investment outcome depends on what remains after taxes, fees, and other financial costs are deducted. Depending on eligibility and circumstances, accounts such as 401ks, IRAs, and HSAs can provide tax advantages, while employer matching can add benefits. Eighth, increase your earning power by developing valuable skills, negotiating compensation, advancing professionally, changing careers. Cutting expenses has limits, but income can potentially grow substantially, especially when additional earnings by lifestyle inflation and unnecessary upgrades. Ninth, track your net worth periodically by measuring what you own against what you owe, giving yourself a clearer scorecard than income alone today. Reviewing net worth monthly or quarterly can reveal whether assets are growing and debts are declining without allowing market movements to create unnecessary anxiety. 10th, regularly audit your finances by reviewing subscriptions, debts, savings rates, investments, insurance, taxes, and major financial goals to keep everything aligned. Small adjustments can meaningful improvements, such as canceling unused expenses, increasing automatic investments, eliminating lingering debt, or rebalancing investments when appropriately. Reading hundreds of money books will not make you wealthy by itself, because knowledge becomes valuable only when actions consistently transform income into ownership. Ultimately, wealth repeated for years. Earning more, spending carefully, consistently, controlling financial friction, and giving enough time. The real advantage comes from building a repeatable system that works through market volatility, career changes, unexpected expenses, and changing financial goals for decades.